Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Christy Aquilian, Head of iShares Investment Strategy Americas at BlackRock. And we are talking about the market outlook and investing strategies for 2025. Christy, welcome back. Great to have you with us today.
Thanks and Happy New Year. It's so great to be here.
Happy New Year. Can't believe it's just not even been 3 weeks into January. And it seems that there's already so much happening in the markets in 2025. Stocks are up one day, down the next, and they are reacting to every single economic data point. And bond yields also surged, then they have moderated somewhat. So let's start with the recent surge in market volatility. What's driving that volatility?
Yeah, absolutely. It's been an eventful start to the year, even if you just sort of look at where equity markets and where bond yields are now. It maybe belies the path that we took to get here, which was certainly more volatile than I think that many had been expecting. So, I think one big thing, and you mentioned that markets are certainly paying attention to that tier one macro data. We've gotten jobs so far this month. We saw inflation. Jobs were hot, inflation was cool. That resulted in a bit of tug of war in terms of risk assets, and we saw equity markets respond in both directions to that. But I'd also add in that there's just a lot of policy uncertainty. So, while we've been used to dealing with the macro uncertainty side of things, I think that this year is also going to be one that is very defined by headlines. And as we start to get sort of the outlines, if you will, of what trade policy and immigration policy are going to look like, those obviously have really important reverberations down to corporate profitability and therefore, stock markets as well. And so, it feels like a year where we should expect volatility to be the norm rather than otherwise. But that said, we came into this year with still a risk on attitude. We are still overweight at equities. And I know we're going to get into that a bit more. All I would say here is, especially as a bull market gets a little bit longer in the tooth, it is expected that it gets more volatile. So while we do think the market can still continue to trend up, it's not going to be a straight line. So, I guess that's a long-winded way of saying, expect to live with some of that volatility this year.
Right. I totally agree with you. Investors should brace for more volatility until a clearer picture of Trump's policy agenda also emerges. And that said, we always recommend that investors should generally ignore these day-to-day fluctuations and focus on the longer-term outlook, 1 year and even beyond. And you released your 2025 investment directions recently. And in the note, you recommend an overweight position in U.S. equities. And we have seen this outperformance by U.S. large cap stocks over the past decade or so. They have trounced almost every other asset class in the world. And you expect this U.S. exceptionalism to continue in 2025. And investors should maintain an overweight position in U.S. equities. Tell us why.
Yeah, absolutely. And I know, that the longer it continues, the more investors maybe start to think about mean reversion. But for us, the guiding principle that we're following in terms of where we like to allocate to within our portfolios is really just going to be the macroeconomic data and how that translates into markets and corporate profitability. And so the exceptionalism that we're seeing is really in the strength of the U.S. economy. I think the story of 2024 was how the U.S. economy and the growth of it continued to surprise to the upside. At the same time, the rest of the world and many of the developed markets were actually slowing quite a bit faster. And so I think part of it can be chalked up to the strength of the U.S. consumer, which was enduring throughout 2024. And signs still look pretty good for right now. And that really strong growth that we saw at the economic level, most importantly, translated, to corporate profitability that was much stronger in the US than the rest of the world. So when we look at earnings growth, it was very strong in the US, even though it wasn't expected to be. Again, earnings growth surprised to the upside in the same way that economic growth did. And if you look forward, the expectations and the forecast for that show a similar picture. So earnings growth in the US for this year over year, is expected to be about 8%. That's higher than we expected last year, but it's in line with what was actually delivered. And that's still stronger than we're seeing in Europe. It's stronger than we're seeing in Japan. I think there are pockets of opportunity outside of the US, but we do feel very confident in that US story continuing, at least while the economy keeps surprising us to the upside.
Right. So as we talked about US exceptionalism, and that has been driven mainly by these mega cap tech giants, because they have been doing so well over the past few years. And that is the reason why the indexes have become so top heavy, so concentrated. And many investors have been talking about the concentration risk, and that the market is just too top heavy now. And you alluded to this hopes for a reversion to the mean. So tell us why this top heaviness of equity indexes should not be a concern for investors.
Yeah, absolutely. I think this is the biggest topic of conversation right now when we're speaking to investors. So I'll spend a couple minutes here, but I think there's two things. One is investors have been concerned about market breadth, about the really the very strong concentration, as you alluded to, at the top of the index. And that has certainly been true. That was true last year as well. Coming into 2024, we were having a lot of concerns or a lot of conversations with investors who were concerned about market breadth. The good thing is that we actually have seen that expand out over the course of 2024. So just kind of looking at last year's performance, we actually saw every sector but one deliver positive performance. That's a big improvement and a sharp contrast to what we saw the year prior, when only 4 sectors were in the green, right? So we're seeing the breadth expand out in terms of performance. We're also seeing it expand out in terms of earnings. So in all, breadth is better for a bull market, and we are seeing it improve. So I think that's one thing to take into account. The other side of it, though, too, is valuations and what it means if so much of the returns have been powered by just a few companies, and what does that mean for valuations? Here I think it's interesting to dive in a little bit into kind of the shape or the complexion of the index itself. So if we're looking at the S&P 500 as an example, it is trading more expensive than it has on a historical basis on average. It's about 20% richer than it's been over the last 2 decades, right? But I think importantly, back to that, the shape of the index, it's much more concentrated in growth names than it is in value names. And growth names always trade at a higher multiple. And so, the comparison between 2025 S&P 500 and, maybe 2015 or even going back to 2000 index is very different in terms of that value growth mix that you get at the index level. So I kind of like to say, it's not that this time is different, it's that this index is different. And so I think it should, and it's reasonable that it trades at different valuations. But even so, I know investors are a bit concerned. I like to look at the actual performance that was delivered. So again, kind of looking back at 2024, more of the S&P 500's returns came from earnings per share growth than they did from multiple expansion. So that's good. Even though the market did get a little bit richer, it was really it was really supported by stronger growth as well. And then when you look at the Magnificent Seven names, which it's hard to talk about the broad index without talking about those names, about 80% of the returns were driven by earnings per share growth, and only about 20% was because they got more expensive. If you look at other parts of the market, that mix is much less favorable. And so that does, it does leave us inclined to be less concerned, I guess, about some of those high-flying tech names at the top of the index, because their earnings growth has been strong enough to justify the prices that they have been trading at. And so, I think that It's a little bit less of a worrisome headline than you might imagine, but it's still one, where we think it pays to be selective, even so.
Right. I totally agree with you. These indexes are very different now. So these are the earlier top constituents a few decades back for these railroad companies or oil companies that did not justify the kind of multiples that we are seeing now. And you talked a little bit about growth, that these are growth companies, and these are also higher quality companies. And in fact, we have seen that quality and growth factors have done very well over the past few years. Last year, momentum also did quite well. So tell us why you still expect quality and growth to do well, and why investors should still focus on quality and growth companies.
Yeah, absolutely. So on the growth side, I've talked about that a little bit. We couldn't have a market outlook conversation in 2025 without talking about AI. But certainly, we are believers in that theme. We think that is sparking sort of a new wave of innovation across sectors. But we like growth in an environment where there are strong expectations for future growth, and we think that we're in that right now. So, we're not as much leaning into value at the broad value level, because some things are cheap and they're cheap for a reason, right? So we still do have a preference for growth over value, but really, really importantly, in this very specific macro environment that we're in, as you mentioned, we have a strong preference for quality. Something like QUAL, which is our iShares Quality ETF. We very much like the way that this is constructed, and that it takes a sector neutral approach. So this is not just a technology fund. This is a fund that screens for high corporate profitability, low variation of earnings over time, and then perhaps most importantly, it screens for low leverage. So companies with very strong balance sheets, and it delivers the highest quality companies within each sector. And I think that it's that last component, and we've talked about this, before, in an environment of higher for longer interest rates, which was, something we have been saying for a while now, but also is the reality in 2025. I think we're in this very unusual environment where, even though we're seeing the Fed cut interest rates and policy rates are coming down at the front of the curve, longer term rates are staying higher, or staying higher, even moving higher. And so I think that type of environment, which again is very unusual in historical context, where we still have strong growth and very solid corporate profitability, but we do have higher, longer term interest rates, is one where we prefer to be in the company, and be invested in the companies that are less exposed to those higher interest rates. And so those companies with the strongest balance sheets, the highest cash flow, have less of a need to tap the capital markets, and they can do better if interest rates stay higher. And that is one of our expectations for this year, is probably less cuts from the Fed in terms of policy rates than anybody was expecting even a few months ago. And also for the longer term, the long end of the yield curve to stay higher. So it's not your typical Fed cutting playbook where you might expect small caps and value to do well, because longer term rates are still staying higher. So that really underpins our preference for quality.
Makes sense. Now, going back a bit to US exceptionalism, and you mentioned that there may be some pockets of opportunities in the international markets as well, while the US economic growth continues to surprise to the upside. And we have seen that international stocks, particularly those in emerging markets, have been under pressure since election, particularly due to concerns about President-elect Trump's proposed trade and tariffs. And the IMF, they just updated their world economic outlook, and they raised their forecast for US economic growth in 2025 and lowered their growth estimates for other advanced economies. So tell us why investors should look at international exposures. Why should they not just continue investing in US equities?
Yeah, certainly. And if you look at past performance, that certainly would have also pointed you to a very large overweight in U.S. Equities. And so this is a question that we do get quite a lot. I think the most important answer here is just diversification. So, we do see opportunities in, international exposures, and particularly ones that can have different drivers of risk and return. I talked a lot about quality in the US markets. We also think that quality makes sense internationally as well. So something like IQLT is a good way to get invested and get to the diversification benefits of some international markets, but still be able to do so in a higher quality way using similar screens. I also think dividends in international markets can be a compelling story right now. There's lots of different ways to think about dividends. We think of it also as one metric or one possible screen for quality companies too. So something like BID, which is a newer active product that we launched in that space that is specifically looking, and seeking dividends. I think that's another great option. And then in terms of kind of pockets of opportunity too, and being selective is really a big part of our thesis here. We continue to like countries like India that we think are going to that are growing quickly, that have the benefit of some demographic tailwinds, and may even benefit from some of the policy changes as an important trade partner for us in the region. So I think that's more of a long-term play. Investors who are just looking for some of the diversification benefits, either be up in quality or source some dividends from those markets as well. So yeah, there's still reason to be invested there, even if we are overweight the US.
Now, let's talk a little bit about the fixed income part of the portfolios. And you mentioned that longer term rates are staying higher or even moving higher this year. And US Treasury bonds, they had a tough 2024, particularly intermediate to long term bonds. And it seems that those intermediate to long-term bonds will continue to face headwinds this year as well. So where should investors look at opportunities in the fixed income markets amid rising uncertainty over monetary policy as well?
Yeah, absolutely. And we are still seeing tremendous opportunity in fixed income markets. But I would say that we're characterizing that in what we're more focused on the income portion as opposed to the duration portion of fixed income. And what I mean by that is, there are, high all-in yields on offer right now, especially if you look to some of the securitized asset classes. If you look at high yield, sort of outside of maybe the core bond sectors. But, we would temper that with the fact that we don't expect a big boost in bond total return from the duration component. So we don't expect interest rates to come down. So there's less capital appreciation. We think this is going to be a year that is about investing more for those coupons. And so, a lot of the conversations we're having on the fixed income side, are really predicated around that thesis that we think economic growth is strong. So we do feel comfortable taking some risk in fixed income. Default rates are low, interest rate coverage ratios are high. It is a good environment for taking risk, but we do we do like those plus sectors, maybe outside of core bonds. So, we talk a lot about BINC, the BlackRock income ETF that is actively managed by Rick Reeder and team, that it can rotate and it can take advantage of those higher yields that we see in maybe some more niche parts of the market that your average investor doesn't feel as comfortable going into themselves, maybe emerging market debt, maybe securitized, but can really try to balance that, the trade-off between high attractive yields but relatively low corporate spreads. So there are opportunities, but we're not extending duration too much because we don't think that the long end of the yield curve is necessarily going to deliver in terms of performance this year. We're actually a bit hesitant. So focusing on income, and then also really thinking, zooming out a little bit about the importance of diversification within a portfolio. We haven't seen longer term bonds deliver the same amount of diversification or ballast in a portfolio that we have previously. So we like bonds for their income. we're a little bit less enthusiastic specifically about the long end of the yield curve for their diversification principles.
Makes a lot of sense. And BINC has been quite popular with investors. Active management makes a lot of sense in the fixed income space in particular. So in your note, you also talk about key risks in 2025. There are many that investors should not ignore. And then you also highlight some hedges across asset classes. So tell us about those key risks and how investors can hedge themselves.
Yeah, absolutely. And again, the theme I think you could pick up from this conversation, or if you read our investment directions piece, is that we are pro risk. But the other side of a pro risk stance coming into this year is just being aware of what the possible risks are and what you can do in your portfolio to potentially mitigate against them. So yes, we do list out many risks in this section. Let the count of number of risks not influence too much what our actual outlook is here. But yeah, I'll go into a couple. So, I think that this is, again, an unusual macro environment. The biggest risk that we would see to this, to this market and this bull market is if we saw growth that slowed, but inflation that did not, right? And we're certainly not expecting, it is certainly not our base case. We're not calling for a stagflationary environment, but there is a world where economic growth is slowing. We expect it to slow back to closer to trend, but we're not expecting it to dip much below that. And we're certainly not expecting a recession. At least that's not what the data shows us for right now. But in a world where inflation is picking up or accelerating at the same time, growth is slowing, that can be a very difficult mix and a very difficult for a 60-40 portfolio. When we think about the possibility of inflation re-accelerating, again, this kind of goes back to where we started the conversation of there are so many unknowns in terms of policy agenda and priority and what's actually going to get passed. And so I think in some respects, if we do see inflation reaccelerate, it really depends on what the cause of the inflation is in terms of how to potentially mitigate it in your portfolio. So, for example, we talk about trade policy. So if widespread tariffs get implemented and retaliatory tariffs get implemented in the other direction, we do think that there's an opportunity to think a little bit thematically. And we think that focusing on domestic manufacturing could make sense. We also have an active ETF that really focuses on tech independence. So IETC is the ticker for that. And we think that that is another one that can kind of benefit from an America First agenda, if that is in fact what we see. So inflation that comes from tariffs, we like a little bit of a thematic approach in terms of how to benefit from the companies that may do well in that environment. But on the other hand, if inflation comes from a change in immigration policy, if labor, if the labor supply is curbed in a meaningful way, then I think it's a little bit more about considering sectors like technology and robotics and maybe avoiding some of the more labor market sensitive sectors like consumer staples or home builders. So we get a little bit prescriptive in the report that we've written in terms of what the potential risks are and also where they're coming from. But I think that one of the more fruitful conversations we have been having with investors who are concerned about some of these risks are some of the more innovative products that we've launched more recently, and some of the things like buffered strategies, which I believe we've talked about and have certainly been an important portfolio tool for investors, even just in the last few years. But we're looking at something like IVVB, which is just our iShares, large cap. We're calling it the deep buffer. But essentially what these products do is they let you trade away some upside potential in exchange for, guaranteed downside protection and use options to do so. Again, these are our newer products. I think that they offer a tremendous sort of portfolio construction tool that investors didn't have, access to before. So I think that can be kind of the catch-all type of investment that investors have if they're worried about some of these risks and they just want to build a portfolio that lets them sleep at night. So, still being able to participate in some upside, but just having some more certainty of outcome has been something that's been really appealing for investors in, this very volatile market that we find ourselves in.
I love buffer ETFs, and I can totally understand why they have been so popular with investors, and they make a lot of sense for risk-averse investors in particular, those who are nearing retirement or in retirement already.
Absolutely.
So any conversation with BlackRock should mention IBIT as well, because that has amassed over 56 billion in assets, and this has become the most successful ETF launch in history. And since we now are going to have a crypto-friendly administration, so this ETF and crypto ETF space in general could see more innovation and growth in 2025. And I saw a recent note, BlackRock note, recommending 1 to 2% allocation to Bitcoin. And you talked a little bit about buffers ETFs also. So the allocation to these alternative strategies, to Bitcoin and to buffer ETFs, should that come from the fixed income sleeve in a 60-40 portfolio?
Yeah, so it's a very interesting portfolio construction question that I think investors had been grappling with for a while, and that's part of the reason that we wrote this piece. My answer here though is really it's going to depend upon the investor and their specific goals and their risk tolerance. So as much as Bitcoin has been and IBIT has been the most successful ETF launch in history, it's not for everybody. So, I think that, whether you're managing your portfolio on your own or you're working with a financial advisor, having conversations really around your specific risk tolerance are going to be more insightful in terms of how to fit these things into your portfolio.
That's quite helpful. And we'll have to leave it there. Christy, thank you so much for joining us today and for sharing your insights.
Of course. Thank you so much for having me.
That was Christy Aquilian of BlackRock. Now let's recap some of the ETFs that we discussed today. So she talked about QUAL ETF, QUAL. It is the iShares MSCI USA Quality Factor ETF, very popular ETF. And in full disclosure, I own it in the ETF investor portfolio that I manage. For international quality stocks, she mentioned the iShares International Quality Factor ETF. The ticker symbol is IQLT. For fixed income and actively managed fixed income, she talked about BINC, BINC. It is the BlackRock Flexible Income ETF. And for investing in India and Japan in particular, because BlackRock sees opportunities in those countries, iShares has the MSCI India ETF. The ticker symbol is INDA. I also like a product by Wisdom Tree. It is EPI. It is the Wisdom Tree India Earnings ETF. And I own EPI in the ETF investor portfolio that I manage. And I like it because it tracks the performance of companies that are profitable. And for Japan, iShares has a popular product. It is called the iShares MSCI Japan ETF. The ticker symbol is EWJ. And I also like DXJ by Wisdom Tree. It is the Wisdom Tree Japan Hedged Equity ETF. And I like it because it focuses on Japanese exporters and hedges out fluctuations in the currency. So no currency risk with this particular ETF. And then we talked about the Bitcoin ETF. And the ticker symbol, as you know, is IBIT, IBIT. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcasts. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.